Welcome, or more specifically, welcome to you, the learner listening right now.
Yeah, we are incredibly glad you've decided to carve out some time and join us today.
Exactly. It is Tuesday, March 3rd, 2026, and we have a dense, fascinating, and frankly, paradigm-shifting stack of material mapped out for you today.
We really do.
Our mission on this deep dive is ambitious. We are going to completely deconstruct and then hopefully rebuild your entire understanding of financial literacy.
It's a big promise, but the source material supports it.
Right. We're looking at a foundational text on wealth building.
Yeah.
It's a source that suggests the traditional rules of money. You know, the conventional wisdom we've all been spoon-fed since childhood.
Go to school, get a safe job.
Yeah, exactly. That those rules are not just slightly flawed, but are actively keeping people broke.
It's a really provocative premise, and one that feels increasingly urgent right now.
Definitely.
We spend so much of our lives operating under these inherited financial scripts without ever really pausing to audit them.
Yeah, we just accept them as gospel.
Right. And the source material we are examining essentially argues that our societal definition of financial intelligence is entirely backward.
Completely upside down. And to hook you right away, the central question of this material is this. Why might a highly educated doctor, someone who spent a decade in rigorous higher education and residency, why might they be functionally illiterate when it comes to their finances?
While a 13-year-old dropout could go on to build an absolute financial empire.
Okay, let's unpack this.
What's fascinating here is how the author immediately draws a very hard, non-negotiable line between making money and actually keeping it.
Which are two very different skill sets.
Completely different. In our culture, we conflate the two. We assume a high income automatically equals high wealth.
Right, if you make $1 million, you're a millionaire.
But this text argues that making money is merely the first step of the equation. And if you don't understand the mechanics of retention, the actual architecture of wealth, that high income is practically meaningless.
It just flows right through your fingers.
Exactly. And to illustrate this, the author provides a historical anchor that I think sets the tone perfectly for everything we are going to discuss today.
Yes, the tragedy of 1923. Let's paint the picture for the listener.
Please do.
So it is 1923. The Roaring Twenties are really gaining momentum.
The economy is booming.
Booming, and a group of the most powerful leaders and richest businessmen of the era hold a meeting at the Edgewater Beach Hotel in Chicago.
We are talking about the absolute titans of global industry and finance here.
The concentration of economic power in that single room is almost difficult to comprehend by modern standards. You had Charles Schwab.
Right, the head of the largest independent steel company in the world.
Samuel Insull was there.
The president of the world's largest utility. A man who essentially built the modern electrical grid.
You had Howard Hobson running the largest gas company. Ivar Kruger.
The president of International Match Co.,
Right.
which was a massive global monopoly at the time.
And it wasn't just industrial monopolists either. The absolute apex predators of Wall Street and global banking were in that room.
Like Leon Fraser, president of the Bank of International Settlements.
Richard Whitney, the president of the New York Stock Exchange.
Arthur Cotton and Jesse Livermore, two of the most legendary market-moving stock speculators to ever live.
Plus Albert Fall, a sitting member of President Harding's cabinet.
So this was the pinnacle.
The absolute pinnacle of success. If you measured success by income, influence, and net worth in 1923, these men had undeniably won the game.
And here's the pivot. The source material doesn't bring them up to celebrate their achievements.
No, it doesn't.
It asks us to look at what happened to these specific men 25 years later.
And the outcomes are universally devastating.
9 of these titans ended their lives in complete and utter ruin.
It's hard to even fathom. Schwab, the steel magnate, died penniless. He lived his final 5 years entirely on borrowed money.
Samuel Insull died broke in a foreign land.
Ivar Kruger, the Match King, and Arthur Cotton both died flat broke.
Howard Hobson actually went insane.
And the financiers fared no better, right? Richard Whitney and Albert Fall were eventually released from prison.
While Leon Fraser and the legendary Jesse Livermore, a man who, by the way, actually made millions shorting the 1929 crash, both ultimately committed suicide.
It's a brutal reality check. Now, the text points out that 1923 was, of course, just before the 1929 market crash and the subsequent Great Depression.
Right. The macroeconomic environment completely collapsed.
That catastrophic event undeniably destroyed their empires. But the underlying lesson the author is extracting here is vital for us today.
Yes. Money acts as a magnifying glass.
A magnifying glass.
It magnifies human flaws, it magnifies risk tolerance, and most importantly, it magnifies existing behavioral cash flow patterns.
Hold on, I want to challenge that slightly.
Go ahead.
It's easy to look back at 1929 and say, well, it was the Great Depression, everyone lost everything. Are we really saying that these men who literally built global industries lacked financial intelligence? Or were they just victims of a black swan event?
That's the exact question the text forces us to confront.
Okay.
The author's thesis is that intelligence solves problems and produces money. But money without financial intelligence is money soon gone.
Interesting distinction.
Consider Samuel Insull or Jesse Livermore. They were indisputably brilliant in their respective fields of utilities and market speculation. They had massive professional intelligence.
Right.
But leveraging vast amounts of debt to build a monopolistic empire works flawlessly in a bull market. The moment the macroeconomic winds shift, that leverage becomes a guillotine.
So the insight here is that high-level intelligence in your profession does not automatically translate to the risk management and retention skills required to keep wealth across decades and economic cycles.
Exactly.
Which brings a terrifying modern parallel into focus. The author warns that we live in times of even greater, faster, and more volatile change today.
Oh, without a doubt, the boom and bust cycles are accelerating.
We see this with tech valuations, cryptocurrency, real estate bubbles. If people think a high salary or a sudden windfall of money alone will insulate them from these macroeconomic shifts, they are operating on a very dangerous assumption.
Precisely. If you don't know how to manage capital, having more of it will not save you. It will likely just accelerate your exposure to ruin.
And the text provides modern anecdotes to prove this isn't just a 1920s phenomenon isolated to old-school industrialists.
We culturally idolize the idea of making millions overnight.
Just look at our societal fascination with lottery winners.
Yeah, that's a perfect example.
Yet the statistics and stories the author highlights remind us of the grim reality. A staggering number of lottery winners go from being poor to suddenly multimillionaires, and within a few short years, they're completely bankrupt again.
The massive influx of cash didn't change their financial behavior. It just amplified it until the money ran out.
Or consider the world of professional athletics. The text shares a rather devastating anecdote about a young professional basketball player.
I remember that one.
At 24 years old, he was at the top of his game, earning millions of dollars. But by age 29, just 5 years later, he was entirely destitute, forced to work at a car wash for minimum wage.
And the psychological toll of that fall is staggering.
Yeah. According to the story, he claimed his friends, his attorney, and his accountant took his money. He refused to take personal responsibility for his lack of oversight.
He was actually fired from that minimum wage car wash job because he refused to take off his championship ring while wiping down the cars.
Right. He appealed the termination, claiming hardship, stating that the ring was the only thing he had left, and if he couldn't wear it, he would crumble.
It is a tragic, profound illustration of the core thesis. It's not how much money you make, it's how much money you keep and how many generations you keep it.
That former athlete is clinging to a literal, physical symbol of past professional success because he completely lacked the foundational financial aptitude to retain the wealth that his success generated.
The source material is warning us that our society is dangerously obsessed with the acquisition of money rather than cultivating our greatest actual wealth, which is our financial education.
So, if financial education is the bedrock of keeping wealth, how do we actually build it?
Well, the text uses a structural metaphor here that I think is incredibly clarifying.
It contrasts the process of building the Empire State Building with the process of building a standard home in the suburbs.
Right. If you are commissioned to build the Empire State Building, what is the absolute first non-negotiable step?
You have to dig a massive, cavernous hole into the bedrock of Manhattan and pour an incredibly deep, reinforced foundation.
You spend a tremendous amount of time and resources going down before you ever build a single story upward.
Right, but if you are building a typical suburban home, you don't need to do that. You just pour a 6-inch slab of concrete, let it cure, and you start framing the walls.
And the systemic problem, according to the author's critique, is that most people in our society, driven by the desire for immediate visible wealth, are trying to build a financial empire state building on a 6-inch slab.
They are trying to build a massive financial structure with zero underlying foundation.
And we have to ask, where does that lack of foundation come from? Why are so many intelligent, capable people operating on a 6-inch slab?
The text points a very critical finger directly at our traditional school system.
It argues that our educational system was fundamentally designed during the agrarian age and heavily influenced by the needs of the industrial age.
It was built to train people to be compliant workers and specialists.
Exactly.
Let me play devil's advocate here, though. We do teach math, we teach macroeconomics, we teach calculus. It's not like schools are entirely devoid of
They
numbers.
aren't devoid of numbers, no, but they are devoid of personal financial application.
Okay, fair point.
The school system teaches scholastic skills, reading, writing, arithmetic, which are undeniably essential. And it teaches professional skills, how to be a good engineer, a good lawyer, a good accountant.
But it leaves young adults with a dirt floor when it comes to personal financial aptitude.
You can graduate at the top of your class with an advanced degree in aerospace engineering and have absolutely no idea how compound interest works against you on a credit card.
Or how inflation erodes your purchasing power.
Right.
Which leads perfectly to what the text brilliantly terms the Leaning Tower of Suburbia.
It's a grim but accurate image.
It really is. You have these highly educated professionals, they graduate, they land the high-paying job, and they immediately start trying to live the American dream in suburbia.
But because they possess no deep financial foundation, they quickly find themselves drowning in consumer debt, burdened by massive mortgages, and suffering from sleepless nights.
So what's their solution? They decide they just need to get rich quicker.
They try to build their financial skyscraper even higher on that same fragile 6-inch slab.
It goes up rapidly, they buy the boat, the second car, the luxury vacations, but it is structurally unstable. It's the Leaning Tower of Suburbia, perpetually on the verge of toppling.
To really grasp why this happens, if we connect this to the bigger picture, we have to look at how cultural prestige and economic reality have shifted over the last few decades.
The text notes that back in the 1960s, the blueprint was very clear.
Very clear. If a student excelled academically, the immediate assumption by parents and teachers was that they should become a medical doctor.
Because historically, that specific profession carried the promise of the absolute greatest financial reward and societal stability.
Academic success had a very clean, direct correlation to long-term professional and financial success.
But look at the landscape today. It is entirely fractured.
The text points out that modern doctors face incredible, complex financial hurdles that have nothing to do with medicine.
They have insurance companies dictating their treatments and eating into their margins. They navigate labyrinthine managed healthcare systems.
They deal with intense government regulatory intervention.
And they operate under the constant, expensive threat of malpractice suits.
The pure financial reward of the profession has been heavily diluted by systemic bureaucracy.
And kids are highly observant. They see this reality.
This is why the author argues that the younger generation today doesn't necessarily idolize academics or traditional professional prestige in the same way.
When surveyed, many want to be famous athletes, movie stars, tech founders, or social media influencers.
They see that the massive visible wealth and prestige in our current culture are no longer strictly tethered to traditional academic pathways. They recognize the old blueprint is outdated.
So what does this all mean for you, the learner listening to this right now? Why should you care about the history of the education system or the shifting prestige of doctors?
It matters because it is a vital mental uncoupling you have to perform.
You need to realize that you can be highly educated, you can be wildly respected in your profession, you can earn a top-tier salary, and you can still be completely financially illiterate.
There are millions of educated people worldwide who are pursuing their professions brilliantly, yet they are bleeding cash.
They are working harder and harder, putting in 80-hour weeks, and they are not getting 1 inch closer to financial freedom.
Because the missing link in their development was never how to make money. They know how to generate an income.
What is missing is financial aptitude, the skill of managing the capital once it is generated.
It's knowing how to strategically protect it from taxes and inflation, how to keep it circulating in your portfolio longer.
And most importantly, how to deploy that money so it works vigorously for you rather than you working vigorously for it.
Which brings us to the absolute core philosophy of this entire deep dive.
Yes. If you take only one concept away from our time today, it needs to be what the text calls rule number 1.
It is presented as the simplest yet most universally ignored rule of wealth generation.
You must know the difference between an asset and a liability and buy assets.
It sounds almost absurdly simplistic, doesn't it?
It really does. In fact, the text shares a story where the author and his childhood friend are being mentored by a rich dad figure. When this mentor tells them that the single rule is the foundational secret to wealth, The kids actually think he is joking.
They were anticipating some highly complex, esoteric financial formula.
And all they received was, know what an asset is, know what a liability is, and spend your life acquiring the former.
The genius is in how the text redefines those two words.
Because if you open a standard dictionary, or if you ask a classically trained accountant to define asset and liability, you are going to get a dense paragraph about economic value, depreciation schedules, and future benefits.
Which makes complete sense to a CPA, but is practically useless to an average person trying to manage their paycheck.
Exactly. The definitions our source material provides are revolutionary in their pragmatism. An asset puts money in your pocket. A liability takes money out of your pocket. Period. End of discussion.
And that absolute simplicity is precisely why highly educated adults struggle with it so profoundly.
How so?
Well, the author argues that intelligent, academically decorated adults often feel it is intellectually demeaning to rely on such elementary definitions.
They want it to be complicated.
Right. They have spent years being conditioned by bankers, financial planners, and academic economists to use complex, sophisticated jargon.
To accept that wealth building comes down to a definition a child can understand requires them to dismantle their own intellectual ego.
The difficulty isn't in understanding the concept. The difficulty is asking an educated adult to unlearn their conditioning and look at money through the pragmatic lens of a child.
It's the classic KISS principle, keep it simple, stupid, or as the text politely amends it, keep it super simple.
The mentor in the text didn't teach these concepts using spreadsheets or complex financial models. He used simple line drawings to illustrate the literal movement of money.
He focused entirely on behavioral cash flow.
Right, the author essentially boils it down to behavioral cash flow patterns. We all know what an income statement and a balance sheet are in theory.
But the text argues that the vast majority of the middle class fundamentally misaligns them in practice.
They use their income to purchase liabilities, incorrectly labeling them as assets because of what traditional accounting allows, which then generates a self-defeating permanent cycle of expenses.
Let's actually visualize this behavioral flow, because the text breaks down 3 distinct cash flow patterns that essentially dictate a person's entire life trajectory. Let's start with the cash flow pattern of the poor. Where does the dollar go the second it hits their bank account?
In the cash flow pattern of a poor individual, the financial story is incredibly brief and focused entirely on survival.
They exchange their time and labor for a job which provides a salary. That salary enters their life as income.
But almost immediately, that capital flows directly out through the expense column. It is immediately consumed by the necessities of basic existence.
Rent, food, basic transportation, utilities, clothing, and taxes.
There is absolutely zero capital left over to flow down into their balance sheet. Their asset column and liability column remain completely empty because every cent is spoken for by immediate survival needs.
The money comes in, the money goes out. It's a straight line equation. Now let's contrast that with the cash flow pattern of a person in the middle class.
This is where the behavioral psychology gets significantly more complicated and, frankly, a lot more deceptive.
Yes, the middle class pattern is a trap disguised as success.
The middle class person also trades their time for a job and receives a salary into their income column. Often, it's a very healthy salary.
But here is the crucial behavioral pivot. Their cash flow doesn't just go to basic survival expenses. It flows down into their balance sheet first, specifically into the liabilities column.
They utilize their high income to qualify for debt to acquire liabilities.
Yeah.
A massive 30-year mortgage, auto loans for depreciating luxury cars, revolving credit card debt for consumer goods.
And massive student loans for the degrees that got them the job in the first place.
And here's the tragedy of it. They firmly believe they are buying assets.
They look at the car and the house and the designer furniture and think they are building a portfolio.
Exactly. Because traditional accounting allows them to list those items on the left side of a ledger, they feel secure.
But if we apply rule number 1, an asset puts money in your pocket, a liability takes it out, the reality is stark. What do those acquisitions do?
They relentlessly bleed capital.
So the cash flow originates from the income, moves into the liability column to purchase the house or car, and then those liabilities generate a permanent stream of mandatory expenses.
Mortgage interest, property taxes, maintenance, car payments, insurance.
The income buys a liability, which generates an expense, which permanently drains the income.
It is a continuous, exhausting loop of financial hemorrhage, perfectly camouflaged as material success.
Which brings us to the third pattern, the cash flow pattern of the wealthy. This is the blueprint. How does their financial story read differently?
The individual who is building genuine wealth focuses an almost obsessive amount of their energy and capital on the asset column of their balance sheet.
Instead of buying consumer debt, they acquire or build things that generate independent capital.
Cash flowing real estate, dividend paying equities, bonds, intellectual property, automated businesses.
These assets are entirely separate from their daily labor. The cash flow originates in the asset column, flows up into the income column in the form of rental income, dividends, or royalties.
That independent income is then used to cover their living expenses.
And the real magic happens when the excess income, the money generated by the assets that isn't needed for survival, is immediately reinvested directly back into acquiring more assets.
So what does this all mean when we look at the advice given to people struggling financially?
It means that the most common refrain we hear in our culture, "I'm drowning in debt, so I just need to figure out how to make more money," is a fundamentally flawed, mathematically impossible solution if their behavior doesn't change.
Inherently impossible. Because if your mental software is running the middle-class cash flow pattern where every dollar of income is subconsciously earmarked to service a liability or an expense, then injecting more money into that system just means you will qualify for and purchase more expensive liabilities.
If your behavioral pattern is to consume everything you generate, a pay raise simply results in lifestyle inflation.
The text uses a great blunt phrase, "A fool and his money is one big party."
More money doesn't solve financial ignorance. It only accentuates and accelerates the cash flow pattern already running in your head.
This philosophy leads the author into presenting a really powerful narrative. It's framed as the classic story of hardworking people, but reading through it, it feels like an excruciatingly relatable American dream financial nightmare.
I want you, the listener, to pay close attention and see if any steps of this journey sound familiar to you or people you know.
It's a brilliantly constructed case study of the middle-class trap. It begins with a happy, highly educated, newly married young couple.
They are starting their lives together and move into a cramped, modest, rented apartment.
Initially, they feel great because they realize two can live almost as cheaply as one. They have surplus cash.
But the apartment is small, so they formulate a plan. They will save their surplus money to eventually buy their dream home and start a family.
They are both ambitious. They both have solid careers. So they are operating on dual incomes. They put their heads down, focus on their professional development, and predictably, their incomes begin to steadily increase.
From the outside, everything appears to be going perfectly according to the societal script.
But here is where the snare tightens. As their top-line revenue increases, their expenses rise in lockstep, sometimes even faster.
And the text isolates a very specific, often overlooked reality here. For most working professionals, their single largest lifelong expense isn't food or housing, it's taxes.
Here's where it gets really interesting, because the author makes a very specific mathematical point about taxation that most people never consider.
When we complain about taxes, we usually talk about income tax. But the text argues that for many working class and middle class Americans, the heaviest burden is actually the payroll tax, specifically Social Security and Medicare.
Now, we need to be clear. We are just presenting the author's mathematical perspective on cash flow here, not taking a political stance on the validity of the social safety net.
Of course. But from a pure accounting standpoint, the author points out that while your pay stub shows roughly a 7.5% deduction for these taxes, the true cost to your wealth building is effectively 15%.
The logic behind that is grounded in how employment compensation actually works. The employer is legally required to match that 7.5%.
The author's argument is that the employer's match is capital the business was willing to spend to retain your labor.
It is effectively money they could have paid you in salary, but cannot, because it is mandated to go to the government.
You never see it, but it was part of your labor's market value.
And to add insult to injury, you are still taxed on the gross amount of your salary, meaning you are paying income tax on the portion of your wages that was withheld for Social Security money that never actually hit your bank account.
So, returning to our young couple, their incomes are climbing, but they are losing a massive percentage right off the top to income taxes, payroll taxes, and hidden matches.
Regardless, they look at their savings and decide it's time. They take the leap and buy the house of their dreams in the suburbs.
And the very moment they sign those mortgage papers, an entirely new ecosystem of expenses materializes.
They now have a mortgage payment, but they also have property taxes, which can increase annually regardless of their income. They have homeowners insurance.
And human nature takes over. They have a beautiful new house with empty rooms, so they naturally want it to look nice.
They go out and buy new furniture, new appliances. Maybe they lease a new SUV to sit in the pristine driveway.
Fast forward a few months, they wake up one morning, sit down at the kitchen table, and finally take a hard look at their personal balance sheet.
That liabilities column we mapped out earlier, it is overflowing.
They have massive mortgage debt anchoring them. They have revolving high-interest credit card debt from furnishing the house. They have a depreciating auto loan.
The liabilities have skyrocketed, and their cash flow is stretched to the absolute limit.
At this point, they are officially entrenched in what the text famously terms the rat race. Then life happens. A baby comes along.
This introduces childcare costs, medical bills, and future education savings requirements.
They feel the financial suffocation, so what is their only logical response based on their training?
They work even harder. They ask for overtime, they push for promotions, their gross income goes up again.
But this success just pushes them into a higher tax bracket, a systemic phenomenon known as bracket creep. They are making more, but keeping proportionately less.
And just when they feel they can't breathe, the mail arrives. It's a pre-approved credit card offer.
They justify using it just to get through a tight month, and before they know it, it's maxed out. They are drowning in high-interest consumer debt.
But then a lifeline appears. A loan officer calls them up with incredible news. Congratulations.
Yeah.
Your greatest asset, your home, has appreciated in market value. Because you have a history of paying your bills, we can offer you a home equity line of credit, a bill consolidation loan.
The sales pitch from the bank sounds incredibly sophisticated and mathematically sound.
The bank advises them to tap into the equity of their home and use that capital to wipe out all the high-interest credit card debt.
Furthermore, the interest they pay on the home equity loan is often tax-deductible, whereas credit card interest is not. On paper, it looks like a brilliant financial maneuver.
They jump at it, they sign the papers, and they pay off the credit cards.
They sit back and breathe this massive collective sigh of relief. The Visa and MasterCard balances are at zero. They feel like they've won.
But let's dissect what just actually occurred on their balance sheet.
What occurred is a tragedy of financial illiteracy. They didn't eliminate their debt. They merely moved it.
They folded short-term, unsecured consumer debt into long-term, secured debt tied directly to the roof over their heads.
Yes, their immediate monthly cash flow might improve slightly because the interest rate is lower, but they just extended the repayment of a sofa and a vacation over the next 30 years of their lives.
But because they lack financial education, they genuinely believe they just executed a highly intelligent financial strategy.
And because they believe they were smart, and because they see those zero balances on the credit cards, human behavior kicks in again. What happens next?
A neighbor calls, "Hey, there's a massive Memorial Day sale at the luxury outlet mall. Let's go."
Our couple promises themselves they're just going to window shop. They've learned their lesson. But as they walk out the door, they slip that newly zeroed out credit card into their wallet just in case of an emergency or a deal too good to pass up.
It is the inescapable psychology of keeping up with the Joneses. The author notes that he consults with couples exactly like this all the time. The names change, their specific professions change, but the underlying financial dilemma is eternally the same.
They sit in his office, stressed and exhausted, and ask, "Can you teach us how to make more money?"
Because they fundamentally, structurally do not understand that their crisis has nothing to do with their income generation. It is entirely a product of how they choose to allocate the money they already possess.
The root cause is that they never learned the difference between an asset and a liability. I want to point this directly at you, the listener. Think deeply about your own cash flow over the last 90 days.
The author shares a piece of advice a friend gives to people in deep debt, and it is profound in its unapologetic bluntness. If you find you have dug yourself into a hole, stop digging.
Are you currently digging a hole? Are your recent raises or bonuses going toward acquiring assets, or are they just servicing a higher tier of lifestyle liabilities?
It's an incredibly uncomfortable mirror to hold up to oneself, and the text provides a fascinating cultural framework for why we actively avoid asking ourselves these difficult questions.
To explain this avoidance, the author invokes a Japanese legend about the three great powers in the world: the power of the sword, the power of the jewel, and the power of the mirror.
Let's explore this legend because the metaphor is powerful.
The sword obviously symbolizes the power of weapons, military might, and physical force. The jewel symbolizes the power of money, the golden rule of he who has the gold makes the rules.
But the third power, The mirror.
The mirror symbolizes the power of self-knowledge and introspection.
And according to the legend, the mirror is considered the most treasured and potent of the three powers. Why? Because true self-knowledge is the only thing that prevents a human being from blindly, mindlessly following the crowd.
The text argues that the vast majority of the poor and the middle class allow the power of the jewel, the power of money, to completely control them.
But not in the sense that they are greedy. Rather, they are reactive. They just get up, go to work, and push harder, mindlessly repeating the mantras they have been handed down.
Go to a good school, get a safe, secure job, your home's your biggest investment, diversify your 401k.
They never stop, look in the mirror, and ask themselves the terrifying question, does any of this actually make mathematical sense for my life?
This systemic failure to look in the mirror is deeply rooted in primal fear. The text makes a brilliant evolutionary connection here.
It notes that if you look at psychological surveys, for most people, the fear of public speaking ranks higher than the fear of death.
Psychiatrists explain that the fear of public speaking is not really about the act of talking. It is the primal evolutionary fear of ostracism.
It is the deep-seated terror of standing out from the tribe, the fear of criticism, ridicule, and ultimately being cast out as an outcast. In ancient times, being separated from the tribe meant death.
So keeping up with the Joneses isn't just vanity. It is literally an evolutionary survival reflex playing out in our checking accounts.
Exactly. And the author connects that exact same primal fear directly to our modern financial behavior. People play it incredibly safe for their capital because they are terrified of standing out from their peer group.
They conform to popular financial trends because there is perceived safety in the herd.
Everyone says mutual funds are safe, so I'll just do that. Everyone gets a 30-year mortgage, so that must be the right way.
They are so terrified of being different, of being judged by their neighbors or families, that they refuse to seek out or trust new, unconventional ways to solve their financial problems.
Which brings us back to the rich dad mentor figure in the text. Think about this man. He left formal schooling at 13 years old. He had no degrees to hide behind.
Yet, as an adult, he was the one directing, instructing, and employing highly educated professionals, bankers, corporate attorneys, CPAs.
How did he achieve that inversion of power? Because he valued the power of the mirror above the power of the crowd. He actively trained himself not to fear ostracism.
The text notes that this mentor intensely detested the phrase, "We have to do it this way because that's the way everyone else does it."
He viewed conventional wisdom as a trap. He hated the word can't. He was a man who insisted on doing his own rigorous thinking. He possessed the psychological fortitude to separate himself from the herd's assumptions.
So the challenge for you listening right now is to look into your own financial mirror.
When you make decisions about your money, are you doing so because you've run the numbers and they make objective mathematical sense for your personal cash flow?
Or are you signing the paperwork because society, your parents, or the prevailing conventional wisdom told you it was the responsible thing to do? Are you letting the subconscious fear of ostracism dictate the contents of your balance sheet?
That is a heavy, necessary question. And applying that unforgiving mirror leads us directly into what is undoubtedly the most controversial, heavily debated point in the entire source material.
If you are listening to this on your commute or at the gym, brace yourself, because this specific argument attacks the very foundation of the American middle-class ethos.
The text argues, unequivocally and without apology, that a house is not an asset. It is a liability.
Okay, hold on. I have to stop you there and push back heavily on behalf of the listener. That sounds like absolute heresy. It goes against literally everything the middle class has been taught for a century. Historically, home equity and property appreciation have been the primary, sometimes only, vehicles for generational wealth in this country.
True.
How does the author justify calling the roof over your head a piece of real property that generally appreciates over time, a liability? Is he just playing semantic word games with accounting terminology?
It's not a word game. It is a strict adherence to the cash flow definition we establish in rule number 1. This is where the difference between the traditional poor dad paradigm and the rich dad paradigm becomes starkly visible.
If you look at the traditional, highly educated father's balance sheet in the text, he proudly lists his primary residence in his asset column.
But the wealthy mentor explicitly lists his primary residence in the liability column. Why? Because we must return to the absolute simplicity of the definition. Does a primary residence put money into your pocket every month, or does it take money out?
Well, obviously, it takes money out. You have the monthly principal and interest on the mortgage. You have local property taxes that never go away. You have homeowners insurance. You have the utilities required to run it. And you have the endless parade of maintenance. The new roof, the broken HVAC, the landscaping.
The cash flow arrow clearly points out of the house, into the expense column, and out of your life.
Precisely. The author is fully aware of how deeply unpopular and triggering this idea is. He notes that people challenge him on it constantly, often with immense anger, because a primary home is a highly emotional possession.
It represents safety, family, and status. And as the text wisely points out, when it comes to money, high emotions tend to lower financial intelligence.
When people defend their home as their greatest asset, they're usually defending their emotional attachment to it, not its mathematical performance as an investment vehicle.
Okay, let's break down the math then.
Hmm.
Why is treating your primary residence as your primary investment so detrimental? The text outlines three massive hidden losses incurred by the common middle-class strategy of buying an expensive house too early in life, instead of deploying that capital into truly cash-flowing assets.
Walk us through these losses. What is the first one?
The first, and perhaps most devastating, is the loss of time. Time is any investor's greatest, irreplaceable advantage.
If you take all your available liquid capital and pour it into a down payment and then commit a massive percentage of your monthly income to servicing a high mortgage and property taxes, you lose years, sometimes critical decades, during which that capital could have been invested in true assets that grow exponentially.
A heavy mortgage literally steals the time required for compound growth to work its magic.
That makes sense. The opportunity cost of the down payment is massive.
Okay.
What is the second massive loss?
The loss of additional capital. This is the hidden bleed.
The money you are forced to spend on the inevitable high-maintenance expenses related directly to homeownership, the $10,000 roof replacement, the plumbing emergencies, the rising property tax assessments is capital that is permanently destroyed as far as your wealth building is concerned.
It is money that could have been deployed into acquiring income-producing assets, but instead, it is spent just to maintain the status quo of your living situation.
And the third loss, which the text suggests might actually be the most insidious one over a lifetime.
The loss of education. This is the systemic trap. Too often, middle-class individuals count the equity in their house, along with their basic retirement plans, as the entirety of their asset column.
Because all their available liquidity is trapped in the drywall and granite countertops of their primary residence, they have no risk capital left to actively invest in the marketplace.
And because they never actively invest in real estate, private business, or individual equities, they never gain practical investment experience.
Meaning they never become what the text calls a sophisticated investor.
Exactly. They remain financially uneducated. And the brutal reality of the capitalist system is that the best, most lucrative investment opportunities, the ones with the highest asymmetrical returns, like private equity syndications, distressed assets, or early-stage ventures, are exclusively offered first to sophisticated, accredited investors.
Those sophisticated investors capture the massive gains, and then they eventually package and sell the safe, heavily diluted, lower return investments to the financially uneducated middle class, who are desperately playing it safe because they never had the liquidity to learn the game.
Now, we need to be incredibly precise here to ensure we don't misrepresent the source material. The author is not saying never buy a house.
That is the most common, intellectually lazy misinterpretation of his work. He is not advocating that everyone should rent a studio apartment forever.
What he's demanding is that you be brutally honest about the difference between a cash-producing asset and a lifestyle liability. If you decide you want a larger, more luxurious house, the wealthy strategy is not to just work more overtime and sign a bigger debt contract with the bank.
Correct. The wealthy strategy is to delay gratification and first deploy your capital into buying true assets, businesses, paper assets, rental properties that will generate enough independent cash flow to effortlessly pay for the liabilities of the luxury home.
You mandate that your investment portfolio buys your luxuries rather than your physical labor.
But the middle class operates in reverse. They treat their primary residence as their flagship investment. The text argues that this specific philosophy, the deeply ingrained belief that an increase in salary means you are obligated to buy a larger home or increase your consumption, is the foundational bedrock of our debt-ridden modern society.
It is high-risk, high-stress living masquerading as stability, entirely caused by weak financial education.
And this leads us to observe a much broader systemic tragedy. Because the average middle-class balance sheet is overwhelmingly loaded with liabilities and critically lacking in actual cash-generating assets, these individuals become entirely desperately dependent on their W-2 paycheck.
Their livelihood, their health care, their ability to keep a roof over their heads is entirely tethered to the whims of their employer.
Which induces a state of permanent, low-grade panic. They have to play it safe at work. They can't take entrepreneurial risks. They blindly rely on company-sponsored 401k plans or passively hand their money over to mutual fund managers.
They don't have the time or energy to deeply study investing because they are exhausted from working 60 hours a week just to service the mortgage and the credit cards.
So they abdicate their financial responsibility to a fund manager, cross their fingers, and hope the market goes up, falsely believing they are secure simply because they're diversified across a basket of paper assets they don't understand.
But the text astutely argues that this abdication of early financial education is exactly what creates the massive existential risk they face later in life.
When a genuine macroeconomic crisis hits, or conversely, when a deal of a lifetime materializes during a market downturn, they are paralyzed. They can't take advantage of the opportunity because they're working too hard, they're taxed to the absolute maximum, and their personal balance sheet is completely illiquid and loaded with consumer debt.
Which brings us to the harsh, unforgiving reality of the rat race. If you are a standard employee and a traditional homeowner operating on this middle-class script, the text points out a sobering truth. You are not working for yourself. You are simultaneously working to enrich three distinct masters. Let's name them. Who are the three masters?
The first master is the company you work for. As a salaried employee, your daily efforts, your innovation, and your successes are primarily functioning to increase the valuation of the business, thereby making the owner or the shareholders wealthy.
You are systematically providing for their financial success in retirement long before you provide for your own.
The second master is the government. The government legally extracts its share of your labor directly from your paycheck before you even have the opportunity to see it, let alone invest it. And the harder you work, the more overtime you put in, the larger the percentage they take via progressive tax brackets. The text notes that, historically, when you aggregate all local, state, federal, and payroll taxes, most employees essentially work from January 1st until sometime in May exclusively to pay the government. You don't start working for yourself until late spring.
And the third master is the bank. After the government takes its cut, your next largest mandatory expense is usually servicing the debt on your mortgage, your auto loans, and your credit cards.
A massive percentage of your after-tax labor goes straight into the bank's profit column in the form of interest payments. The fundamental flaw with the just work harder mentality is that unless you change your cash flow structure, each of these three masters simply takes a proportionately greater share of your increased efforts.
So the ultimate question is, how do you escape? How does a normal person break free from the gravitational pull of these three masters?
The text suggests the only way out is to start minding your own business. And to clarify, it doesn't necessarily mean you have to quit your job tomorrow and start a volatile tech startup.
It means shifting your primary mental focus and your surplus capital toward acquiring assets for your own balance sheet, rather than just endlessly grinding for a bigger W-2 paycheck to buy more liabilities.
But this paradigm shift raises a vital, practical question. How do you measure your progress once you start this journey? How do you actually know when you have achieved wealth?
Our society relentlessly measures financial success by net worth, but the source material entirely rejects that metric as a vanity number.
Right, because net worth is incredibly deceptive and easily manipulated. It's simply the accounting difference between your total assets and total liabilities, but it's usually artificially inflated by non-liquid, non-productive junk.
It includes the depreciating cars in your driveway, the golf clubs in your garage, and your highly subjective optimistic opinion of what your house might sell for in a perfect market.
If you get laid off on a Tuesday, your net worth on paper doesn't put groceries in the fridge on Wednesday.
Instead, the text introduces a far more rigorous functional definition of wealth borrowed from a thinker named R. Buckminster Fuller. Some contemporaries considered Fuller a fringe philosopher, others a visionary genius. But his operational definition of wealth is razor sharp.
He defined wealth not as a static dollar amount, but as a measurement of time. Specifically, wealth is a person's ability to survive a certain number of days forward into the future if they abruptly stopped working today.
Here's where it gets really interesting, because we can take this philosophy and apply highly practical, simple math to it. Wealth is essentially the ratio of the cash flow generated by your asset column compared to the demands of your expense column.
Let's walk you, the listener, through this math with a basic hypothetical. Let's imagine your total monthly survival expenses. The mortgage, groceries, insurance, utilities, basic transportation amount to exactly $2,000 a month.
Now, let's say you have taken the author's advice to heart. You've been minding your own business, living below your means, and you have slowly acquired some actual assets.
Maybe you bought a small cash flowing duplex, or you built a portfolio of high yield dividend stocks, or you receive royalties from a piece of intellectual property.
And let's say the independent passive cash flow from those combined assets equals $1,000 a month. According to Buckminster Fuller's metric, what is your current level of wealth?
Assuming a standard 30-day month, your asset column is producing exactly half of what your life requires to function. Therefore, your true wealth is exactly 15 days.
You can survive 15 days into the future without trading your labor for a wage. You are making progress, but you are not financially wealthy yet. You still rely on an employer for the other 15 days.
But if you maintain your discipline, if you continue to reinvest that $1,000 back into acquiring more assets rather than inflating your lifestyle, that asset column will compound. Eventually, the cash flow from your portfolio is just $2,000 a month, matching your baseline expenses.
At that precise mathematical moment, you achieve financial independence. You are, by definition, wealthy.
You might not feel rich, you aren't buying a yacht or flying private, but if you quit your job or get fired today, your assets completely cover your life's overhead. You are no longer desperately dependent on your wages or your employer. You have bought back your time.
And the final, ultimate stage of this wealth-building architecture is to reach a point where the cash flow from your assets exceeds your living expenses.
When you take that excess cash flow and systematically reinvest it back into the asset column, a beautiful phenomenon occurs. The assets grow larger, which makes the cash flow grow larger, which buys more assets.
As long as you maintain the discipline to keep your personal expenses below the ever-growing cash flow, you grow richer automatically, independent of your physical labor.
The text likens it to planting a tree. You have to carefully water it, prune it, and protect it for years, but eventually its roots dip deep enough into the water table. It no longer requires your daily intervention, and it provides permanent shade for you to enjoy.
It is a profound, sustainable image, and it serves as the perfect antithesis to the fragile leaning tower of suburbia we discussed earlier.
As we begin to wrap up this incredibly dense deep dive, let's distill everything we've covered into the ultimate foundational lessons from this source material. It all boiled down to observing and understanding three distinct behavioral patterns regarding money. Number one, the truly wealthy focus entirely on buying cash-producing assets.
Number two, the poor, trapped by necessity and lack of education, only have expenses.
And number three, the most dangerous trap of all, the middle class buy liabilities that they incorrectly think are assets.
At the end of the day, financial independence is not about working harder for the three masters. It is about understanding the behavioral story your numbers tell.
It's about cultivating the emotional intelligence to know the difference between an asset that feeds you and a liability that bleeds you.
I would strongly encourage you, the listener, as you finish this deep dive and go about the rest of your day, to run a mental audit of your own personal balance sheet. Look at the cash flow patterns we just spent the last hour deconstructing.
Which column is your daily labor and energy actually feeding? Is your 40-hour work week building a robust asset column that will eventually provide you with permanent shade? Or is your hard work just buying bigger shovels to dig a deeper hole of lifestyle liabilities?
It all comes back to having the courage to look in that mirror.
And before we sign off, I want to leave you with one final, slightly provocative thought to ponder on your own. It extrapolates on everything we've debated today. The text makes it clear that the primal fear of ostracism, the fear of not keeping up with the Joneses, is the primary psychological engine that keeps the middle class trapped in a cycle of buying consumer liabilities.
It's powerful stuff.
But imagine for a moment, what would actually happen to the global macroeconomic landscape if an entire generation suddenly woke up, overcame that evolutionary fear, looked in the mirror, and completely stopped buying disposable, depreciating stuff?
What if millions of people simultaneously rejected the leaning tower of suburbia and strictly focused every spare dollar on acquiring cash-flowing assets?
Would our modern consumption-driven capitalist system completely collapse under the lack of consumer spending, or would it be forced to radically evolve into something far more sustainable and entirely new?
It is a genuinely fascinating, almost terrifying scenario to game out in your head.
It really is. Thank you so much for joining us on this deep dive. We know this material challenges deeply held beliefs, but we hope it has shifted your perspective and equipped you with some vital new tools to analyze your own financial foundation. Until next time, keep learning, keep looking in the mirror, and keep questioning the rules.